Hello everyone, I'm Dave Wright, Head of Tax and Accountancy Publishing for Bloomsbury Professional, and I'm here today with Mark McLaughlin, Consultant Editor for Bloomsbury Professional. Hi Mark.
Hi Dave.
I thought it would be good to, while you're here, to talk about some of the cases we've been reporting in the Bloomsbury Online Current Awareness Service in the last few weeks, and one of the ones recently which caught my attention related to discovery and careless behaviour on behalf of an advisor, and that was Hicks.
Yeah. Okay, so Hicks was an upper tribunal case, and it basically covers discovery. There's a long succession of cases on discovery, and this is the latest one. There are a number of issues in the case. For example, was there actually discovery by the revenue? The tribunal said that there was. Was the discovery stale? So in other words, was there a long time delay between the discovery being made and the assessment? And the tribunal said there was no issue of staleness there. And so it came down to a third issue, which was whether the accountant who advised the taxpayer had been careless. Okay. Basically, the taxpayer entered into an avoidance scheme in 2008, and the scheme involved creating a big loss, which he carried forward to the next two tax years. The revenue opened an inquiry into the year of the loss itself, so that was fine. That could be dealt with by the inquiry. But the scheme itself wasn't found to be defective or wasn't found not to work until 2016, I think it was. Eventually, the revenue raised a discovery assessment, or two discovery assessments, one for each year. One was within the 4-year time limit, so that was basically okay, I think. But the other one required carelessness, because that was a discovery assessment on the basis of carelessness. Right. Means that the revenue can assess up to 6 years rather than 4. Okay. So the revenue needed to have this 6-year window instead of 4. So they needed to be able to prove carelessness. So what they tried to say was that the taxpayer's accountant had been careless in recommending the scheme. Right. Now, the accountant didn't actually formulate the scheme. It was another company called Montpellier that arranged the scheme. Yeah. They advised the accountant what to put on the tax return, and the accountant recommended the scheme to the taxpayer. And the issue was really around whether he'd been careless in not finding out more about the scheme and actually recommending the scheme. I think he said to the taxpayer that if he was in the taxpayer's position, that he would do the scheme himself. And I think he also said that it was a no-brainer. So in saying these things, he actually recommended the scheme. Yep. And the tribunal said that in doing that he had a duty to the taxpayer to at least have known about the scheme more, and not just to copy and paste what he'd been told to put on the taxpayer's return. So the taxpayer basically lost on that basis. The assessments were held to be valid on the basis of careless behaviour, and so the taxpayer's case was basically dismissed. Okay. And that was the essence of the Hicks case. Yeah, so really interesting precedent there, I think. Yeah. And for anybody advising on these schemes, you can read more about this case if you're a subscriber to the Bloomsbury Professional Online service. And there's some useful links there as well, Mark, I think, isn't there, to the relevant legislation, and also a really useful chapter on discovery in the HMRC Investigations Handbook. So yeah, that's right. Plenty of reference material there. Yeah, and I think there is actually a section on reliance on an advisor, right, which is quite useful as well. Yeah. Cool. Okay. Thanks very much.